You're listening to the Generational Wealth Through Commercial Real Estate podcast. Your host, Will Smith, is a former NFL player that found his passion in commercial real estate. Every week, you will learn from industry experts everything you need to know to get started investing in commercial real estate to build generational wealth.
So today's guest is Josh Eitingon. Mr. Eitingon is the co-founder of DXE Properties. He brings a keen eye to each acquisition, identifying opportunities for growth. With a focus on optimizing property performance, Josh works closely with management to drive each business plan. Prior to DXE, Mr. Eitingon founded JAE Property Group. JAE was born with his first deal, a real estate investment of a 20-unit distressed property in Cincinnati, Ohio. Mr. Eitingon oversaw all major operations of the company, was instrumental in all phases of acquisition, asset management, and investor relations. Through JAE, Mr. Eitingon and partners established a portfolio of multifamily investment properties clearly fitting to a well-defined investment strategy. Prior to JAE, Mr. Eitingon was one of two members of the acquisition team at URS Capital Apartments, a real estate investment company located in Huntington, New York. Josh was an integral part of the company's growth from its infancy to purchasing over $100 million worth of real estate assets. Ladies and gentlemen, Josh Eitingon. How you doing today, man?
Doing well. Thanks for having me, Willie.
Yes, sir, man. It's a pleasure to have you on the show. So just give us a little bit of a background of how you got involved with real estate.
Sure. So probably like a lot of people, I read a lot of books. Like I read the Rich Dad, Poor Dad books and a lot of entry-level real estate books. I was always attracted to the simplicity of it, people paying down your mortgage and cash flowing and being a really good wealth builder over time.
Right.
I started in sort of an entrepreneurial path, and then I took a route into the professional side of it.
Mm-hmm.
I jumped right in. I was working full time at a software company and bought that 20-unit deal in Cincinnati, distressed, about 8 years ago. And then I was hooked. I mean, all sorts of ups and downs with that first project, but it ended up being really successful. And it was the building blocks for what was next. So after a few years and continuing to do more deals, I left my job to work, basically cut my salary almost in half.
Right.
As an analyst for a real estate investment group, worked my way up to one of two acquisitions guys there.
Mm-hmm.
And ultimately, it was really, really helpful. I was able to really learn the business from a group that was doing it at a much higher level.
Right.
And then ultimately, I left that company to really formalize DXE Properties, our investment group. And at this point, I mean, we've acquired probably $35-40 million worth of real estate.
Wow.
We're doing it at a what I think is a pretty moderate pace. Looking 2 deals or so a year that are just good deals that we can continue to grow off of. And even though I started in Cincinnati, our focus at DXE is really the Southeast, specifically the Carolinas.
Yeah.
A couple markets in Georgia we'll look at, and then a couple markets in Florida. But we're really trying to be focused on the Carolinas, leveraging the teams and relationships we have there.
Right. No, that's great. Thanks for letting us know that. So, there's a lot of different asset classes out there. I mean, you got mobile home parks, self-storage, hotels. So why did you guys kind of decide to go with multifamily over the other asset classes?
I think there's no right answer. Both myself, my partner, we have experience across a few different asset classes. We still own a couple neighborhood shopping centers. We've both done residential condo projects, for sale product. I think multifamily, and most people know this, it's the steadiest of the asset classes in real estate.
Right.
We're young, we're long-term focused. We just believe in it. I think it's, of the bunch, the most tax efficient and probably safest bet of them. we're not looking to buy anything built in the last 5 years that's pretty
Yeah.
operating perfectly. We're looking to still uncover those unique opportunities where we could buy into some value and create a lot of value by swinging a hammer and doing what we know best, which is the capital project side of things.
Right, right, right. I mean, it's really hard to go wrong when you can buy a property at a discount or that's undermanaged and bring some efficiencies in there and raise the rent. So that's always a plus when you can identify those kind of opportunities. So you've been doing this for a couple of years at this point, but if you can kind of think back when you was first getting started, what was your biggest challenge?
Um, I think in some ways, I started really young. I mean, my first property, I was literally living at home paying $200 to rent my own bedroom to my bed.
Right, right.
Um, so I think being a little bit naive was helpful, frankly. Because
Mm-hmm.
I just, I was able to tell myself, what do I really have to lose? And the answer was very, very little.
Right.
That's not really an answer to your question. I think for me at that point in time, the biggest challenge was that I did it with very little money.
Yeah.
I did need to raise money from, an extended friends and family network, where
Right.
I wasn't raising money in 50 or $100,000 chunks.
Yeah.
Literally giving promissory notes for $10,000 at a time, for
Right.
that really just bet on me because they knew I was a good person.
Yeah.
So that was a challenge. It was a comfort zone test.
Uh-huh.
And, ultimately I got there, and those people have been my biggest supporters. They're still with me today. And a lot of people
Wow.
took a flyer on, hey, Josh, I have no idea if you know what you're doing, but
Yeah.
here's a shot, to
Right.
now people that are reinvesting $100,000 over and over again on some of our projects. So
Right.
it's great to see, but I think that was the part that definitely kept me up at night.
Yeah.
Um, and I didn't even know the unknowns at a property level at that time. But
Right.
it should have been keeping me up at night in hindsight.
Yeah. Yeah, yeah, for sure, man. So, I know a lot of my listeners are going to be kind of new to this game, and they're trying to figure out the best way to get going. And a lot of these people are not going to be able to just bring $200,000, $300,000 to the table. So, what's a good tip you can give them in regards to approaching family and friends to raise money for deals?
Sorry, I'm drinking tea.
No, you're good, man.
Um, I think it's be careful with it. Honestly, it was a different market when I started 8 years ago.
Yeah.
For better or worse. I mean, I think I was lucky in some ways. I wish I could have gone bigger faster when I was then.
Right.
And now is a scary time to be buying. I mean, you really, really have to understand the variables associated with every single deal, uh,
Right.
and to be able to make a intelligent investment decision, and especially when you're raising money from other people. It's such a
Absolutely.
to take a dollar from anyone, that I think for you or one to do it uninformed is such a disservice, and it's gonna bite you. So my advice
Right.
would be, take your time, learn, try to learn from people that are doing it at a level above you. In whatever capacity you could get involved with them.
Right.
And, be in a place that you could act when you're ready. But if
Yeah.
you picked up a book a month ago, you'd be the last person I'd be giving money to.
Right, right. Absolutely. Absolutely. And that's so funny to hear you say that, man, because you have these guys out there that's, I'm not going to give any names out, but they say go big or go home, start with 100, 200 units, like, you know what I mean? So they're basically setting people up for failure when they're coming like that and they're just getting into the game, right?
Yeah, I mean, I get where they're coming from, because with scale, in a lot of ways, it does get easier. And I've experienced it from all different ranges. That first 20-unit deal to, on the professional side, acquiring and asset managing hundreds of millions, hundreds of units, within a community. I mean,
Right.
150-unit deal that there's truth to it.
Mm-hmm.
But I can definitely, it's more so the risk. I mean, one, you have to be prepared to lose money because you're not
Right.
into a $40 million deal with a $30,000 deposit.
Right.
Application to a lender is not $2,500. This
Right.
is a bunch of non-refundable money in a lot of cases.
Oh yeah.
To be able to step up and play with the big boys in the space.
Right.
Um, but at the same time, I'm all for growing if you can,
Right.
because it's true. I mean, an 80-unit deal in the same location as a 20-unit deal is going to have a lot less headaches for you. I promise.
Right, right, right. I agree with you there. I agree with you there for sure. So, you said the markets that you're focused on right now is basically the Carolinas, some Georgia, some Florida. But, specifically when you're looking at the market, what is it that you like to see that makes you say, okay, this is a good market that has some good growth in it?
It's employment growth, and specifically the types of employers.
Mm-hmm.
I get most excited by higher paying job growth ultimately. And frankly, all job growth is good, but to me, if a company's hiring white collar employees that are going to bring in salaries of over $100,000,
Yeah.
all going to trickle down to just more and more people, um, additional business investment.
Yeah.
And that's what I'm really, really chasing.
Mm-hmm.
It's not to say that that's the only right answer. I mean, we're heavily invested in Charleston, and we
Yeah.
love Charleston, and it's a market that on the from an employer perspective, it's a heavy manufacturing presence.
Right.
And to me, it's not a negative. I think it compounds with the big tourism impact,
Yeah.
a lot of other factors. Um, but if I picked one thing that really gets me excited about a market, it's
Right.
job growth at a higher salary level.
Gotcha, gotcha. Well, if the money's there, then it's a pretty safe bet they're going to be able to pay rent at your community. So that's definitely high on the list for sure.
Yeah, I mean, there's only so many forward-looking indicators. Like you could look at population growth, but that's in the past. You could look at forecasted population growth, but that's probably tied to job announcements in some
Right.
form. Um, so that's what we're chasing, and it's not like we're the only ones doing that. But I think when you think long term, what's a market that's going to be on the map for a long time? That's
Yeah.
that's a driver.
Right. 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 That's fair. Okay. So, as far as the deals, when you're looking at them, what kind of deals are you looking at? Are you looking at only C class, B class? Like, what are you looking for there?
Yeah, I'd say it's mostly 70s and 80s construction, so likely a C and B class asset.
Mm-hmm.
More than anything, we're sub-market focused, where I'd say we're certainly not looking in D or C minus neighborhoods,
Right.
C plus or better type
Yeah.
neighborhood. Um, but at the end of the day, I think the sub-market's a big component of it, where we do look at schools in the area and
Right.
area home prices,
Mm-hmm.
because right now we're really not investing with a 2-3 year time horizon. I just don't think it's a realistic way to invest in
Yeah.
this. So we want to be in areas that can weather a storm, looking out on a 7-year time horizon, 7-10 year time horizon.
Right, right, right. Well, that's good to know. Now, as far as when you're looking at a deal and you're going through your underwriting, you kind of evaluating the area. What are some red flags that will say make you say this is not a deal for me? Like, what are those things that jump off the page to you?
In terms of sub-market or overall market or
Overall market.
overall market, it's diversity of employers. Like I always, it's not fair for me to always call out Fayetteville, but Fayetteville's military driven
Right,
market.
right, right.
So that's something that I'm just not going to be comfortable for any market that's too reliant on just one driver.
Right.
And I'll just to talk myself in a circle, you know,
Mm-hmm.
there really isn't a right answer, because Myrtle Beach is an example of a market that I was always afraid of looking at. I felt like it was all tourism,
Yeah.
and they crushed in looking back 10 years ago.
Mm-hmm.
But they've really bounced back well. There's been a lot of growth, some good diversity of employers coming into that area.
Yeah.
Now I probably still can't compete in Myrtle Beach, just because I don't know that I fully bought into the story,
Right.
but it's a great example of a city that really bounced back well, and you could have done extremely well had you been investing in
Right.
that. uh,
Yeah, those are some good points for sure, man. Now, there's a lot of guys getting into the syndication game right now. Everybody's talking about, like I said, go big or go home, and obviously you got to syndicate to make that happen. So, what are some big rookie mistakes you're seeing people make right now?
um I think that it's ultimately it's price point driven. I mean, a lot of people that are starting off with, you're not bringing management in house for your first deal, second deal. So,
Right.
you're going to be using a third party manager. There's plenty of good third party managers, and there's nothing to say that that person or that individual is not going to hire the right person.
Yep.
I think the really scary deals to me are the deals that are in, the C minus parts of town, that you're buying on a cap rate, paying a six cap to be in a C or worse location.
Yep.
Um, I think those are the areas that really, really are going to get hurt with the downturn.
Right.
To me, it's just the profile that I'm afraid of. That's not necessarily to blame the syndicator or a guy doing the deal, but it's just the type of deal that I think is scary to buy right now.
Yeah, yeah, yeah. I mean, I would agree with you for sure on that. Now, let's go to the next segment of the show. We're going to do a deep dive on, a deal that you've recently done, so we could just kind of learn a little bit more about, how these deals are put together and what the finance and
Sure.
all stuff looks like. So, the most recent deal you've done, what did you see that made you say, all right, this is one that we want to go ahead and go after?
Yeah, so the most recent deal we did was it's smaller than our typical deal size, but it's a deal I really like.
Mm-hmm.
And it's driven by location. It's in Charlotte. It's right in the heart of Charlotte in the uptown area.
Yeah.
It's just over $4 million purchase price. Um, was owned by a group that owned it for 7 or 8 years. They bought it out of a portfolio. This was by far the smallest deal.
Right.
Sort of fell by the wayside on the management side for them, where they
Right.
had been giving it a huge amount of attention. Um, and we liked the basis for it. I mean, it was a high price per unit,
Right.
$130,000 a unit, but it's
Wow.
there in the center of the city, where you're to millennials. There's an upside play. It's 80s built construction.
Yeah.
Um, and that's the most recent one. We did get agency debt for it.
Yeah.
It was we ended up doing a Freddie Mac loan, 7-year loan, 2 years
Mm-hmm.
in, 80% leverage,
Yeah.
4.1%. So, it's a deal that we love. I think it's a deal that we do not expect to be able to flip out of in 12 or 24 months.
Yeah.
But it's a complete location play where you have cranes scattered throughout all of uptown, and you're just seeing so much growth
Right.
that
Right.
we really like it for that reason.
Yeah. Now you said there was some value add opportunity there. Like, so what value are you guys going to add to it? Is you going to go in and remodel some units, or is it just better management? What's the play?
Yeah, so we're really excited about it, especially with the tenant base that's there. We're going to do a number of technology-driven improvements.
Mm-hmm.
So we're going to bring in like the smart mail stations, like the Amazon Hub or an equivalent to that, where if someone has a package delivered, it goes into a shared mailbox.
Yeah.
It's left outside, and they get a notice on their phone, and then they can unlock their package in that mailbox. We're also rolling out an app for maintenance or requests so that an individual can just open their phone, log the app, and not have to wait on hold to get, a property manager to submit a maintenance request.
Right.
It's a property that doesn't have a huge amount of amenities, smaller. So we're never going to compete with like the property that has the theater and the pool and all things. But at the same time, we're really going to spend some money to give it a sense of personality. We're going to rebrand the property, and just really try to add a little bit of an edginess that I think the younger millennial renter pool will appreciate.
Right. Right.
It's something that not managed aggressively. We bought it with the expectation that we'll be able to move rents like $150 over the next couple of years. And, I think it's definitely going to be there.
Gotcha. Now, I might have missed it, but what is the CapEx you got set aside for this budget? Like, what are you guys thinking per unit?
Yeah, it's about $12,000 a unit on the interiors, and then the exteriors, it's closer to $100,000. It's, again, only 30 units, so it's not a huge amount of property.
Right.
But with $12,000, we'll do new cabinets, hard surface countertop, new flooring, and just really be able to reface it, bring it some consistency.
Right.
Area apartment. So, it's a little outside of the $4,000 renovation.
Right.
At the same time, it's not a $25,000 or $30,000, full unit apartment renovation.
Right. I mean, I think you got a nice little sweet spot there, and with the millennials, I think that's going to be a great value add with the technology you're doing, because they're all about technology, man. So I think you're going to have something good there once you finish getting that set up there. All right, man. Well, I appreciate you talking to me about that deal there. Now let's go into our final segment of the show. It's the lightning round. So I got about 5 questions here for you.
Sure.
All right. So the first one is, what's the best advice you've been given personally in regards to investing?
I guess I hate to come back to location. I could give you 2. I think the simplest is just location. Don't chase a yield. It's not going to be there. Give up the 2 or 3% in yield to be able to be in a better location.
Right.
And part 2, I would, the money doesn't sleep is I like, from a hustling perspective.
Oh yeah.
I think it's just a good motivating thing to be able to look it on your wall and just so that you need to be out there on the phone and hustling and driving around and whatever it may be that applies in your business. I do.
Absolutely.
Appreciate that.
Oh, that's great. I definitely like that one, man. Money don't sleep. I like it for sure. Okay, so what about the book? What's the best book you've read this year?
I'm going to give you a book that I read a few years ago, but it's Powerhouse Principles. It's a good real estate book. It's Jorge Perez, one of the founders of Related, but just a great story of him coming from basically nothing and building an empire. And it's
wow.
It's a good read. It's not too it's a balance between being not too much in the weeds and it's not too fluffy at the same time.
Right.
So it's one that I definitely recommend.
Gotcha. I'm going to definitely check that one out. I've never heard of that one. I'm going to check it out for sure. So what are some rituals you're doing right now that's helping you succeed?
Rituals, I guess ritual-wise, things that I'm always doing, I have like standing placeholder meetings at the beginning and the end of the week with my partner here. Every morning on Monday, we're running down every deal that we have, any deal that's active in the pipeline, and just mapping out the week for things that we're not going to let the week pass without them being completed.
Yeah.
And then on Friday, we're sort of doing the opposite and doing a little rundown, and we just have a Google Doc here that we're always referencing of what did we learn from this week? What went well? What didn't go well?
Right.
People we talked to that we want to work with. It's a running list that we'll reference, but it's something that we like the idea of, and we won't pretend to be larger than we are. We're a growing company that is still figuring out the exact right formula and who we really want to be working with and tied to all these things.
Right.
So that's something that has been really effective for us.
Gotcha. Now, as far as your company go, what is one thing you guys are implementing that's helping you focus on, what your bigger goals are? I mean, I'm pretty sure it kind of correlates with what you just said, but is there anything else that you can think of that you're focused on right now to help your business grow?
The biggest, I'll give twofold answer to that. One, we've done a really good job at this point, like across all the deals that we've done. It's still just been friends and family type investors and equity. All been like grassroots, just us continuing to nurture and grow those relationships, a lot of coffees and dinners and drinks.
Right.
And they're our biggest supporters, and we would never leave them. But at the same time, there is a ceiling to that and the types of deals that we're doing. So we've been making a lot of efforts this year to talk to different groups that could be aligned with us in a way that's not going to hurt us or our investors.
Yeah.
So that's been a big focus. And the other thing is what I really pride myself in the broker relationships, especially as the deal size gets bigger.
Right.
Getting deals through brokers. It's the long and short of it. You're like, especially in the Carolinas, these 30-year South Carolina owners don't want to talk to a New York investor.
That's right.
They need that relationship with someone local.
Yeah.
So I really, really pride myself on maintaining relationships with brokers, and even the Charlotte deal was an off-market deal that we and a few other groups got a quick look at.
Right.
Quickly with hard money, and we were able to get it under control for that reason.
Right. That's great, man. That's great. All right, last question for you here. Knowing what you know now, all the knowledge, all the experience you've had investing, what is one tip you would give your younger self?
It would have been to go to it would have been in college to get a degree in real estate, or like construction management or something, the field that I'm in more directly. My was more like business management, and I started off in the software space.
Right.
I wish I was thinking real estate day one.
Yeah.
And I could have probably sped up everything. And at the end of the day, you're never going to time a market cycle. But had I done that, I could have timed it perfectly.
Right.
I'd be doing this podcast on the beach right now.
That's right. Oh man, that's great, man. Well, hey, I appreciate your time today, Josh, man. Tell my listeners how they can get in touch with you.
Yeah. So DXEProperties.com. We do a monthly newsletter also where we try to just share information on what we're seeing in the market, changes, sharing tips, some of the tech stuff that we're doing. We're going to start publishing and sharing. So please do sign up there. Also, you could shoot me an email, jeitingon@dxeproperties.com, and I'm happy to connect.
All right. I appreciate it, man. And hope you have a great rest of your day, though.
Sounds good. You too. Thank you.
All right. No. Yep.
Thank you for listening to the Generational Wealth Through Commercial Real Estate podcast, brought to you by Onyx Capital Investments. Onyx Capital Investments works with investors nationwide to invest in income-producing real estate in emerging markets. Connect online at www.onyxcapitalinvestments.com to learn more about what we're doing. If we have added value to your life, please leave us a review.